So you may have heard of using home equity line of credit, also known as a HELOC, to fund home improvements, fund educational expenses, as well as making large life expenses that come along the way. But did you also know that HELOCs can also be used for debt consolidation that could help potentially reduce your interest expense as well as improve your credit? So here in this video, we'll go unpack what even is debt consolidation, how you might be able to do it through a home equity line of credit, and I'll give you a visual demonstration to show you how this could work to save you potentially money and time. By the way, my name is Sam Kwok, one half of the Kwok Brothers, a certified financial education instructor, and I've been teaching finance and investments for almost a decade now. So with that out of the way, let's go and get started by explaining what even is debt consolidation. So debt consolidation, just like what the name suggests, is simply consolidating multiple debt that you have, such as multiple credit cards, maybe a couple car loans that you may have, and we're consolidating all these different types of debt accounts that you may have into just one debt. And we simply do this by taking a large enough loan and paying off all these different loans that we may have. Now, personally, as a financial expert, I typically recommend this to individuals that already have a well-planned budget and they have a good understanding of what their income coming in and what their expenses going out is, and making sure that they're positive cash flow. And so if you currently don't have a budget or a meaningful way to track your income and expenses, and you don't really have a firm understanding of your numbers, then I strongly recommend starting out with a budget and really understanding your numbers before considering any kind of debt consolidation tactics. And this is because if you don't have a sound budget and you go on to consolidate your debt, we're not necessarily solving the underlying issue as to what got you into the debt in the first place. So in many cases, we do want to budget and first establish that we have positive cash flow. Then we consider consolidating our debt as a way to pay off our debt and save some interest along the way. So once you have your budgeting out of the way and you know your budget really well, then we move on to the debt consolidation. And this is where we could use a tool like a home equity line of credit, a HELOC, to be able to do this. Now, don't get me wrong, a HELOC is not the only tool to be able to do this. You can do this through a low or 0% interest credit card. You can do this with a personal loan or even a home equity loan. Now, I happen to love home equity lines of credit because they're very versatile, very flexible, and a lot of times they're gonna have a lower interest rate than, say, your typical credit card interest rate. And I often favor a line of credit over a home equity loan or a standard term loan like a personal loan because of reusability. Once we pay off the HELOC down to zero, we're able to use it over and over again in case of life emergencies, or you may choose to use it for an investment, or you want to buy certain assets that can either create income or assets that appreciate over time. So how we would go about using a HELOC to consolidate your debt is, well, first we got to get a HELOC, a home equity line of credit. And to get a home equity line of credit, you obviously need a decent credit score, typically over 640 FICO. And of course, the version of FICO is FICO 2, not FICO 8 or 9. So make sure it's above 640. And for most banks that I typically see, they want the borrowers to be at least at 660 FICO score to be able to qualify. Of course, you need to have 2 years of consistent income coming in, less than 45% debt to income ratio, and enough equity, typically 80% loan to value, to be able to qualify for a home equity line of credit. So once you're eligible, you qualify and you get a home equity line of credit, then what we do is we're able to draw from the line of credit over to your checking account, and those funds will now be used to pay off all the different debt you have, credit cards, maybe other personal loans that you may have. And of course, we're looking to aim and eliminate as much of the high interest cost loans and credit cards as possible. Now, I do have separate videos on how to qualify for a HELOC or what's needed to qualify for a HELOC. I'll leave that video down below in the video description. Now, the question becomes, what if you get approved for a HELOC that has a smaller limit than what you can actually consolidate? Now, this is where a debt sequencing matters quite a bit, and that is simply in what order do you consolidate and pay down your loans. And there's generally two ways to do this. Is one, you could do something called the debt avalanche, or second, you could do what's called a debt snowball. With the debt avalanche method or the sequence, you're first paying off the debt that has the highest interest cost possible. Whereas with the debt snowball, we're gonna go and focus on paying off debt or accounts that has the smallest balance as possible, which focuses on more so on building a momentum and confidence that you're lowering debt overall. So if your total debt balance is, let's say, $20,000, but you only get approved for a $10,000 HELOC, you'll either use avalanche or debt snowball to determine which order and what debt to pay off first, and really depends on what your goal and preferences are. Now, to illustrate why does this save you money, but also helps you save some cash flow, I'm gonna use a visual aid to demonstrate the power of debt consolidation and how it can help you save money and time when it comes to your interest. So here I created a sample demonstration using Excel to show you the power of debt consolidation. So let's suppose we have 3 credit cards, credit card A, credit card B, and credit card C. And the interest rate for those credit cards are 22.5%, 26.7% and 19.5% respectively. Here I have the balance and I have the annual interest as well as the monthly interest and what is the minimum monthly payment using the 1% rule. Now, for those that don't know the 1% rule, it's how the credit card companies determine what your minimum payment is every single month. And the 1% rule is pretty typical. So what they do is they take the 1% of your current balance plus the interest and fees that you would pay on the credit card. So what we've done is we took 1% of the balance plus the monthly interest, and here we have $143.75 as the minimum monthly payment for the credit card. The same logic applies to credit card B and credit card C. And so when we tally everything up, the total interest payment is $341.38 for this particular month. And our monthly payment for the credit card, assuming the balance stays the same, is $536.38. And with our payment, we're only reducing the principal, the actual credit card balance, by $195 for this particular month. So by taking the entire credit card balance that we have and consolidating into a HELOC with the $50,000 limit on an 8.5% interest, okay, and here's our total consolidated debt, we only pay a total interest of $138.13, which is a difference of about $203.25, resulting in about 60% of interest savings right out of the gate. And so we're going from $341.38 just on interest payment alone for this particular month to just $138, which saves us quite a bit of money. Now, if we kept the payment the same, the question becomes, how do we then pay down the HELOC? Now, what's unique about a HELOC with most second lien position HELOC is that the required payment is just the interest. So it's just the interest only payment that is required for the home equity line of credit. You basically get to determine how much principal you want to pay on top of the interest payment. Now, one thing that I recommend is that, yes, you were paying $536.38 for the monthly payment across the 3 credit cards that you have. My recommendation is just keep the monthly payment the same, all right, unless it's gonna get you into a negative cash flow situation. Keep the monthly payment the same, and by doing so, we're now able to allocate more of that payment to reduce the principal or the actual HELOC balance itself. So if we kept the payment the same as we did with having 3 credit cards, $536.38, now $398.25 will go towards reducing the HELOC balance, and $138.13 is going towards the HELOC interest. Now, because we have more of our payment going towards principal, we're able to pay down our debt faster, also reducing the interest costs along the way. Now, if you have more cash flow, or if you have more money to throw at this thing, which will further decrease the timeline, but also the total interest costs as part of paying down the HELOC down to 0. Now, of course, I've given you a scenario where we're just looking at one particular month, but month after month after month, now more and more of your payments, more and more of your money is actually now reducing your overall debt and your loans, and you're no longer burdened by having lots of credit card debt that is accumulating a ton of interest. Now, I am actually not an anti-credit card person. In fact, I'm a huge fan of credit cards for points and miles that you can collect. My recommendation is that at the end of the statement cycle or the billing cycle, completely pay off your credit card down to 0 so that you don't pay any interest whatsoever on the credit card. But you still take advantage of earning points, miles, and cashback rewards. Those could go a long way, especially if you do a lot of traveling like me. So yes, definitely consider consolidating all of your credit cards, especially the high interest one, into a HELOC, but continue to use the credit card for everyday purchases, gas, food, groceries, you name it, but just pay it all off at the end of the month, get those points and miles, and you have a win-win scenario. You get the miles and interest reduction, faster payoff on the debt overall. Now, I did mention also using debt consolidation could help you boost your credit and improve your scores. Now, I did make a separate video on that topic, so if you're interested, click on this video right here where I'll talk about using your HELOC, consolidating your debt, that also could help you increase your credit score and boost your credit overall. With that said, if you enjoyed this video, if you learned something today, be sure to leave your comments and questions down below. Of course, give this video a thumbs up for the algorithm, and we'll see you in the next video.